Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So let me roll along here and get into an area here with Straddles and Strangles that I'm playing with your head. These are a challenge to trade for a lot of reasons, not to mention, like anything else, there's a bunch of research you want to do. But they can be very challenging psychologically for you as a trader. Back to that, encountering a small but quick profit. We put the straddle on, a week out. Before the news of implied volatility starts to come in, and we start to see some really nice stuff there, and then all of a sudden, sure enough, news event comes out, we get the move, the breakout happens, it is pretty good very quickly, and now we've got that profit, as I said, we're waiting as time goes by. Your trading plan is critical to this. Once again, what do I want to get out? What do I like to make out of this thing? Okay, and flexibility to react, adjust, and exiting is an important skill to master, and I go through that in a couple of ways. One, we talk about the adjustments, and number one, to make the adjustment to the account, your account has to have the capability to do that. So you don't want to be all in and then find out you can't make any kind of adjustment to continue potential profit for that. Make a decision to exit. That's not just with the profit. There's also that exit piece, which is much more difficult for all of us, I think, to do is exit when we've not been correct, when what we anticipated, A, didn't occur at the level we thought it would, or B, something's changed that it's not going to have the impact that we thought it would, or conditions change and it's just not there anymore. So this is the one that my wife always used with me when I was trading and stuff. It says, would you rather change your opinion or lose your money? Which is your choice? And sometimes for some of us, admitting we're wrong and changing our opinion, it's tough. It's a tough thing to do, but it's a trading skill you need to master and work hard on to do it. So again, to fight another day on it. Now, the last thing I'd like to do on strategies here is just talk about the short side a little bit. And I should probably have like a drum roll or something put in here to do this. You can sell straddles and strangles. It's not just a long shot trade. Clearly, your account's going to have to be, specifically approved for this doing these sort of things, and your level of experience acceptable to a broker. But now you put a position on that is a short call and a short put. Our structure remains the same or separated strike price and so on. This is really kind of a neutral market rather than an exploding market strategy. This is an income strategy. And once you start to sell options, you define your reward up front. Whereas when you're alongside, you've got quasi unlimited potential, they call it. But in this case, I've told it I've taken in this premium, and that's it, kids. That's the most I'm going to make out of this. So it's a limited profit potential, but boy, it has a large risk potential with it. Those selection criteria still apply. The flip side, however, is now you're looking for volatility is skewed very, very high, and the things need to come in quickly. This is really out of line. The caution there, of course, is always if the volatility is very, very high, what am I missing, not seeing? The reason it's very, very high. Now, it could be, as we've said recently, the entire market's out of control, and it's just a natural thing. Or there could be something that we're not seeing. We may have missed something that has this volatility high. So you have to be cautious. Just because it's high doesn't mean it can't go any higher, or it won't go any higher. Okay, be careful of that deal. However, now, one of the factors that I would enter in that kind of tempers that a little bit is the market looks to be range-bound. All of a sudden, we're in the doldrums. And this is where income strategies across the board on options come into play. We've got that range-bound market, but we want to stay engaged in the marketplace. So we can start doing some of the income strategies. Straddles and Strangles on the sell side, however, really put the risk potential. If you're doing some income spreads, by their nature, spreads have the built-in little bit of a hedge there that they do with construction. So you're not quite as exposed to those things. You've got a bailout position, so to speak. With these, you're kind of stuck on that. So theoretically, unlimited loss. Let's not say it's unlimited. We're willing to change our opinion and not lose our money. And we're saying, but we are going to take a hit. Okay, man up and woman up and take the hit and move on for that. So I think that I would clearly say that, in this case, shorting straddles and strangles, experienced traders, folks that are comfortable with these, have done that, that have experience across the board in other income trades, spread trades, and stuff like that. That I wouldn't venture into this turf except on somebody that's new. I would, however, probably at some point in time, do some fictional trades, paper trades in my options pricing calculators or my simulators, just to see how they would work out on that. So we're up to some questions that we had. Mark says, do I want to be right or do I want to be happy? Mark, I would have to say that if I'm right, I'm probably on my way to being happy from that. So let me just go through a few of these questions here. Well, I implied volatility is right, and I want to do a long straddle. Great question, and it really does. It does play to the market, as I mentioned up front. There are some spots that you say, the strategy just goes on the stealth for a while till things calm down, because it is a market-wide volatility that has pushed premiums up across the board. So trying to now drill down into copper, gold, oil, palladium, whatever else is out there, is going to be very, very difficult, and you're still probably going to find them premiums higher than you'd like on that.
Al, actually, we have one question in the Q&A window from Carl. He's asking, is the Greek vega synonymous with volatility? So in other words, can he assume because an option has a high vega that its volatility is higher when comparing one option choice to another?
Well, Vega's going to show you how much volatility will move for a move in the underlying. So in a sense, yes. If you start to see that vega come up and start to get higher, that is going to translate into, as the underlying moves, the volatility number itself. As vega increases, the volatility piece will start to increase proportionately. So the answer to the question is yes, is synonymous, and it does do that.
We also have a question from Saeed. If you set up a trade a couple months in advance, how do you pick out the strike price?
Okay, Steve, when you're talking about setting up a trade a couple of months in advance, we're going to go, I would look clearly, well, the issue becomes whether you want to do it with a straddle or a strangle. Okay. Straddle, I would say, let's stay with the at money. Okay, we want to do those at the at money. Strike prices at the time. And then if you're doing straddle, you're going to move either one strike or more to either side of that. And I think the caution there is you're going to need to move a couple, because now we've got strike prices that are a lot closer together than like a 5 point. 2.5 might not be enough to do it. You might have to move it out to two strike prices beyond that type of thing. Now, when I'm assuming here when you say set up a trade that you're talking about executing the trade, because obviously the prices of the underlying will change if you're just saying, okay, this is the one I want to look at when it gets closer. You're going to have to readjust to where the pricing is at that point in time. Jeff, these techniques apply to all straddles? Yes, absolutely. In fact, as I mentioned, ETFs are a little bit more challenging in the sense that they're broad market index ETFs anyway, because in general, the theory behind putting a lot of securities in a particular index is to dampen the volatility a little bit. Clearly not always the case. can never say never in that scenario. But that doesn't apply if you're looking at the single ETFs. For example, the currency ETFs that are just U.S. dollar versus the Japanese yen, or U.S. dollar versus the euro. So that volatility translates directly over to the ETF rather than having it dampened a little bit, being less than one of the component issues of an ETF. Let's say it's in the semiconductor industry or one of those particular type of things, or internet industry, that type of thing that are out there.
We have a question.
Randy, you just work with the double and triple bull bear ETFs. Once again, I'll be perfectly honest with you. I haven't sat down and looked at that, see how it works out. But intuitively, it's telling me because they're double, they're bull and bear double, you pretty much already have your decision. You're not questionable. So I don't think you could do it. Long the call in the bull ETFs and long the put in the bear ETFs. I don't know. That really fits into the pattern real well of a true straddle in the market. Once again, I will be perfectly honest with you. I have not looked at that, and that might be an intriguing thing to look at. But I would think that you don't play well in the straddle arena.
We also have a question from Vic asking if there are any books on these topics.
Well, Dick, there's a ton of great options books out there. Just to recommend a ton of them. Obviously, Larry McMillan's books on options and strategic investment. There's a very good small book out called Options, the Options Playbook by Brian Overby of Trade King. I think that's a very good book for beginners because it's extremely well illustrated and extremely focused. Larry's book is phenomenal, considered the Bible, but there's a ton of them coming out there. A lot of stuff. It's tough for me because I guess the tough part of this is I do know a lot of these authors. I don't want to get out there and miss somebody that's a good friend and say, why didn't you talk about my book? But the easy answer is yes, there's a ton of books out there that cover the strategies. I don't know of anything in particular that just focuses on straddles and strangles. Everybody pretty much covers what is a huge spectrum of different strategies. And my only comment on that is somewhere along the line you draw the line and say, I'm comfortable in this space dealing with options. And I don't need to branch out into something very esoteric in its combination. And that could change as your experience level grows, but by and large, you can almost chase yourself away from trading options by trying to get too complicated. I like to do it relatively simple. That's just my personal preference in doing this. But there's a lot of other underlying factors that you can bring into play in looking at strategies and doing an analysis. Bottom line is you need to have an objective. Say, I think this is what's going to happen in the underlying. This is why I think it's going to happen in the underlying. Now, what strategy looks best for me in this? And that could run the spectrum. Not to belabor the point, but you want to look at direction. Where do we think this is going to go? Up or down? How much do we think it's going to go up or down? 10%, 20%, 30%, and when? How much time? When you start to put those three packages together, that starts to push you into strategies that are that fit that forecast. So 20% up within the next 30 days is different than 10% up in the next 30 days. Type of strategy. It's a different risk-reward profile. But again, by putting those three pieces together, you're going to be able to bracket, some strategies that fit into that category and reduce this rather large universe of strategies into a workable group that looks good for you. And let's see. Susan asked, are you better off with only exchange-traded options and or futures versus OTC options? I'm an exchange guy. have been for my entire working life, one way or another. So I'm clearly going to say exchange-traded options are the best way to go, and obviously in the futures and futures on options, but they are a different critter, so make sure you understand how they're structured. On that OTC options of that, they're usually one-off, not always price transparent. That's one of the issues with the OTC market. You're not always getting it. You're not always getting the best price discovery in OTC, because if it's a one-off product, you've got to go back to the guy you got it from to get a price. In the exchange marketplace, it's massive competition for pricing. And that's been the beauty of the competitive marketplace with the options, is for you, the individual investor. Pricing has overall become outstanding because everybody needs to draw the business to their particular exchanges. And ISE has been in the forefront of that. In fact, ISE was, when I go back to my days at Phil, actually, they were a game changer on the marketplace. And the marketplace has evolved extremely well in the options business in particular, I would say, for the individual investor in pricing. So off my soapbox on that, I'm sorry, but stay on the exchange side. If you're going to do futures on options on futures, step back and read them, because they are different in some degree. Tina, anything else?
Mark is asking if there's an email address that he could contact you at. I imagine that a few of our attendees might also be wondering as well.
I could put that in the Q&A, because I think I can get in there. But let me just be more than happy to continue discussions. I did it before, and once again, oops, I got to spell it right before I send it. I don't know if this will. And I will give it to you, so I don't know how this will go out.
Okay, we'll make sure to get that out to them somehow. Okay, great. I think we're all out of time for this afternoon. So I wanted to thank Al for sharing his insights today. Thanks to all of you for joining us. Make sure to visit ISE.com/ETF to see some of the examples of the ETFs that we discussed today. You will find more product info, articles, and a link to sign up for free trade alerts that can help you learn how to best trade these products. These are great for investors who are new to the product, and they're a valuable free tool that we offer to our webinar attendees. We do have a lot of resources available on the ISE site if you're looking to trade products based on some specific industries and sectors, but do make sure to take advantage. If you have any questions or comments, send an email to us at webinars@ise.com. Thanks again to Al, and we hope to see you all back next week.
Okay. Thanks very much, Katrina, and please feel free to give my email address out to the attendees.
Absolutely. Thanks, Al. Have a good night, everyone.
All right, Katrina, thank you. Good night.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.